Good morning. Let's do another What's Up with the Market and do a market status update. We'll go through the similar charts to what we've done in the past, and I've just seen a typo on that slide. It's 7:30 Eastern Standard Time in the United States. Okay, before we get into that, I have to tell you and remind you that nothing that I cover here today, this generic technical analysis that I do of market indices and commodities, I do not use, and it's not part of SPXEW Investor or SPXEW Trader, and I don't use any of this analysis to make any decisions in the two real money public portfolios. In fact, there's a leveraged one as well, 3 public portfolios that I manage with real money, and I don't use this in any of my personal portfolios either. And I just remind you that I'm a 100% mechanical trader, have been for decades, and I precisely follow the exact same systems with my own money that our clients use. Right, that said, also have to tell you that everything we cover here today is not specific investment or personal investment advice, it's general investment advice. Right, straight into Beyond Charts, and we'll start off with not the CRB, we'll go to the Dow Jones where we normally start. Thought I'd set that up, but it's just a quick click or two. There we go. Right, the Dow Jones, long term, looking at that, obviously in a long-term uptrend. It's a secular bull market, and we'll just zoom into the last couple of years here. And I did cover this last Friday in a session I did there on US portfolios. The Dow Jones is well above its all-time high, and I'm keeping that black dotted zone there, which is now become a support zone. And just zoom in. A couple of things to note here. Certainly not in a downtrend yet, but some consolidation. You could put if you wanted to, you could put a little rectangle over here and show that that is coming down to a previous high. Pretty short term. So I tend to let these play out a little bit and form a few more data points. And so won't leave that there in our analysis, but just showing you that that's what it is. Something to point out here, Dow Jones, as it should be in a rising market, underperforming the S&P 500. This is the relative strength chart over here. So things going along pretty normally. I know we've had 3 down days in a row, but that's pretty normal in markets. So just a little bit of taking a breather, I think, would be the theme for today, which markets do. 2 big green up days there. Obviously quite a strong market, relatively strong market, and moving towards the bottom of this channel. And if this plays out like the textbook says it should, we'll find a little bit of support of this lower channel, and then maybe see another rise up through to the median of the channel and maybe to the upper channel line. That's the case for bull. And the case for bear would be that it falls out the bottom of this channel and then goes and tests this all-time high again. That's I'm not going to measure it here. We will do in the next session as to how far these indices are above. You can do the own analysis if you like, how far these indices are above their all-time highs. Onto the S&P 500, pretty similar. We've got 3 down days here. That top over there was a bit of an oops, where it opened high, a bit of a breakaway, opened above the previous close, and then fell down. Didn't quite get into the previous close, but now we've had these other 4 days, 3 days, following days have actually got into this bar over here, this breakaway bar, this new all-time high. That's pretty normal now, just relatively. With the way that I've drawn these trend lines, is the S&P 500 is near the upper end of this channel over here. Now, you could redraw that channel, and you could, for instance, join these upper lines over here, and it would give a slightly different gradient. But I've tried to maintain the same gradient as what the S&P 500 has been climbing at ever since the 2020 COVID crash. But that's not the only way to draw this, and you could play around with other channels if you wanted to. The relative strength, the volatility, and I've put a 1% volatility line in over here. I'll just go out a bit to see when we last hit above the 3.5. So 3.5 is high, 3.5% that is. That's the volatility, the movement, the average true range are measured over 21 days as a percentage of the price of the index. And when it gets above 3.5%, that's getting pretty high. And that would happen when you typically see falling markets. And as the bull market matures, you see volatility drops and gets below 1%. I'm not going to do it now, but you can go back and see the times that it has got below 1%, because one of the little myths out there is that as volatility falls, the closer we are getting to a peak, to where there's going to potentially be a retracement. But if you go back and look, you'll see that this is quite a short period of time of being below 1%. It doesn't mean just because it's got there that we're about to fall in a heap. It can stay there for weeks, many weeks and many months. But it is something that I'm now going to bring into the session just to get a relative feel on how long it stays below 1%, because it is definitely at some stage, when it stays down there for a pretty long time, it can be an early sign, an early sentiment sign of what's happening in the markets. Okay, the only thing to report here on the cumulative new high, new low measurement is that there's a bit of a gap forming between this trend line and the new high, new low, cumulative new high, new low, as this bull market continues to rise, showing a bit more strength, but also then not big enough gap yet to say it's overbought. And but on the cumulative advanced decline line, is the gradient starting to slow a bit? But this gap above this, I've got a 55-day moving average, exponential moving average. The gap is widening a bit over there. So that's there's nothing negative or positive in that. It's just taking note of what's happening there, and this really saying is playing out like it should. On the breadth of market indicator of the number of S&P 500 stocks above their 150-day simple moving average, is I've put some measurements here, and you can go and look at this in your own time. I put a number of blue lines over there, and effectively those blue trend lines on both the S&P 500 chart and the bottom, price action at the bottom, and this breadth of market indicator of number of stocks above the simple moving average. Is what we're looking for is divergence. Now, you'll often find divergence at the peak of a market, but not every divergence leads into that being the peak and the market falling in a heap. So here's a failed divergence here where we had divergence. And so what is divergence? Effectively, the number of stocks that are above their simple day moving average is falling, but the market continues to rise. Falling, continues to rise. Now, that is a failed divergence, because this went on and made a new high, and more stocks started rising, and then we had this little 10%, 12% retracement over here. So not every, and this is the problem with that with subjective technical analysis, is you can really see what you want to see in the chart depending on what the notion is that you're coming into looking at the charts with. Coming with the negative notion, you can go and find all the negativity you like. If you're coming with the positive notion, for whatever reason, wherever it's sourced, you can go and see all the positivity you like as well. So that's just something to keep an eye on. So there's no divergence there at the moment. And when it does come, it's something just to note, not to say, hey, definitely this one indicator is going to make everything fall in a heap. Right. Next we have got the what have we got here? We've got the Russell. Did I miss one? No. Sorry, this chart is a little bit slow. I'm just going to check that what the period is we have here. It is 25 years. Okay. Right. So on the US dollar index, we did miss the US dollar index. Probably one of the most important ones is the US dollar is rising a little bit over here. So you've heard me say before that a rising US dollar is probably one of the most significant things to keep an eye on with respect to looking for some weakness in equities. So there's a little bit of a rise here in the US dollar, but to take out the ups and downs that happen in the short term, what I've done is I've put a smooth rate of change indicator here on this relative strength line. So this relative strength line measures the comparative relative strength, basically a ratio of dividing the US dollar price movement and the S&P 500. And effectively, when it's falling, it means that the relative strength is in favor of equities and not the US dollar. And then I've smoothed, it's an indicator, I'll smooth this relative strength line. And effectively, while this is falling, it's saying that it's risk, it's positive for equities. That's why I've got the green line there. And when it starts rising, when the relative strength, when the Siroc of the relative strength starts rising over here, it's going to say that US dollar is getting the upper hand from a relative strength perspective, and that we should start taking note from a sentiment perspective that maybe there's going to be some weakness in equities to follow. So that sign is not there at the moment. Nor is it in the Russell growth versus the Russell value. It's risk on here. What we're looking for is a dip down. When this falls, it'll mean that that value stocks are getting the upper hand over growth stocks. When growth stocks have got the upper hand, from a sentiment perspective, it's risk on. So that's still in place. Same with consumer discretionary versus consumer staple. This is still risk on. You can see that it's starting to dip a bit over here. And that means that there's a little bit more strength coming into staple rather than discretionary, relatively speaking, but certainly not a sell signal. And if you had to measure that, put a 55-day moving average onto this relative strength line, and it's starting to just dip a bit, starting to lose a tiny bit of value. So a little bit more strength and value than growth at the moment, but nothing to write home about. And puts versus call ratio, the calls still have the upper hand here, which means risk on. Effectively, when this starts rising and we get this red, then we'll be starting to take note of potentially puts getting the upper hand, which means people are getting a bit more bearish about equities. Not the case at the moment. Okay. Next to look at is the yield, 20-year Treasury note. And here it's still risk on as well. Effectively, the theory is that if yields rise, equities will fall. And the relative strength between the two is showing that equities have the upper hand at the moment. And that is why we've got risk on. And when yields get the upper hand, effectively we'll get a red, and we'll see that'll be time. So this is the equity. This is the 20-year Treasury note yield rising, equities falling. It doesn't always happen. The correlation, as I've told you many times, and I'll keep repeating it for those that are new in the session, is that yields the yield to stock ratio doesn't have as much strength and relevance or correlation as what the US dollar to equities ratio has. Correlation has. Right. So the next to look at is, I don't know why this is a bit slow. Maybe I'm not on the latest version. The next is to look at the 20-year Treasury bond. So this is the bond price, not the yield. And in fact, as you know, bonds go up when yields go down and vice versa. So what should happen is if stocks go up when yields fall, means that when stocks, the yield's falling, it means bonds should be rising. So that means that the theory held is that you should always have stocks and bond prices going in the same direction. Not true, because the correlation is pretty low. And what I've shown here is when there's divergence, when they're going in opposite directions. And we have that at the moment. So that red trend line here on bonds is showing bonds falling, which yields up a little bit. It's not a strong downtrend, but it's there nonetheless. But equities are rising. And this relative strength, comparative relative strength at the bottom over here, shows that when this blue line is falling, it means that bonds are underperforming equities, which is certainly the case at the moment. And the rate of growth, the gradient of that is important, because it means that there's more money in equities at the moment than bonds, which happens in a bull market. On the VIX, the fear index, fallen out the bottom. So this is very low. Let's just zoom out here. So this is going back to 1998. Extreme zone is up here, and this is right down near the bottom of volatility on equity markets. Another sign from a sentiment perspective that we are in a rising market, a bull market. So nothing there to be alarmed about. And now we move to the Nasdaq Composite. So Nasdaq Composite is not quite outperforming the S&P 500 in a genuine strong bull market. You'd have the Nasdaq, both the Composite and the 100, outperforming the S&P 500. Not the case at the moment. If anything, slightly underperforming, but we still have on a more smooth, longer-term basis, this indicator over here showing that it's still risk on. And until we get this situation where we have the relative strength between the S&P 500 and the Nasdaq, where it's falling, and you have this blue line happening over here where the relative strength is falling, meaning that the Nasdaq is doing worse than the S&P 500, then that's risk off. We don't have that at the moment, so it's still risk on. to use the terminology that floats around the industry, risk on, risk off. Right, looking at the Nasdaq 100, sorry, I should have also said on the Nasdaq Composite is that it's only slightly above its all-time high. Let me just show you that again. And I'm taking just looking at the at this over here. There's the all-time high, the black zone, and it's the Nasdaq Composite is only slightly above it and holding at the moment. So that's one key thing to look at, which I mentioned a couple of weeks ago, is to see what happens to the Nasdaq Composite with that. The Nasdaq 100 is quite a way above, relatively a lot more than the Nasdaq Composite above its all-time high, the black zone over here. And we have just seen and what I'll do here, this is what I'll do on my own analysis, and I left this to show you, is I'll get a vertical line and we'll put a red one here and just click that, and there is, why am I doing that? Because the CIROC here has fallen below its moving average and also below 90, which is showing that, relatively speaking, the Nasdaq 100 relative, the price movement and the rate of price movement relative to the S&P 500 is slower. So the Nasdaq 100 is starting to slow compared to the S&P 500, and that is, as from a sentiment perspective, a bit of a negative sign, because in a raging bull market, is this sector, this index would typically be stronger and do better than the S&P 500. So a bit of slowing over here, and you can see that relative strength line, the blue line is starting to fall, and the moving average has also had consecutive days of lower values. So a bit of weakness there. This is the cumulative new high, new low of the Nasdaq 100. You can see that's still rising. So there's more new 52-week highs being made than 52-week lows, and the cumulative advanced decline on the Nasdaq 100 is still rising. There's no negativity in either of these breadth of market indicators I've just shown you. Remember, the Nasdaq 100 I showed you isn't falling itself; it's falling relative. Their strength is getting weaker relative to the S&P 500. So just one sentiment, little, one red mark, if you like, in a basket of a number of indicators we're looking at, to say, hey, let's just keep an eye on this. Not an issue at the moment. Here's a second one. This is divergence of this is the Nasdaq 100 stocks. How many of them are above the simple 150-day moving average? And you can see the peaks are declining and the troughs are declining, but the index, the Nasdaq 100, continues to rise. That's the divergence we spoke of, and when I went through this for the S&P 500. So you don't sell at this stage. It's not an indication all on its own to sell. It's just a breadth of market indicator combined with the sentiment that we showed you, is that there's some weakness coming into the Nasdaq 100. And so certainly not risk off yet, but something to be aware of and keep an eye on. This is the semiconductor index, and what we're looking here, we're comparing its relative strength to the Nasdaq Composite, and we've also got a smooth indicator here on the relative strength. And from a sentiment perspective, this is counter to what the Nasdaq 100 is showing us, is that there's still strength in the subsector of semiconductor stocks relative to the Nasdaq Composite. So there's still strength here. So from a sentiment perspective, that's risk on. And it happens so often that you do get confusing and conflicting indicators, which is what makes generic technical analysis so damn difficult, and what can pull people from pillar to post all the time. It just depends where they put the emphasis and the accentuation as to what they're going to do. And of course, the next time they do that, it doesn't work. So that is why we are mechanical. This is the All Ords. The All Ordinaries is above its all-time high, underperforming the S&P 500, which is what should happen in a bull market. US stocks will outperform Australian stocks, and it's above its all-time high. And we want to keep an eye on this index and also the Nasdaq Composite, for them to really break away and get some space between their previous all-time highs and where they currently are. Okay, the Australian dollar is in a downtrend, and certainly a long-term downtrend, and hanging around down there, which is obviously part of that is that there's a strong US dollar. Right, looking at the Nikkei, this black line is its all-time high from back in 1989. It's still above its all-time high, not by a lot, but then it had to go a long way to get above it. But we'll keep an eye on that as well, because it's just another indicator of strength in equities, and that strength is still there at the moment. And the other one, which is really smashing the lights out, is the DAX. So the DAX made another new all-time high in its session yesterday overnight, and continues to grow and get stronger, and is now starting to outperform the S&P 500, as you can see in the relative strength chart down the bottom here. Right, just having a look at a couple of two other indices. One is the S&P 500 equal weighted index, which we've brought into our analysis now. It's also just slightly above its all-time high, not as far as the S&P 500 or the Dow Jones or the Nasdaq 100. But it is important in that some of the smaller and some of the mid and smaller caps, or the mid-cap stocks, that should be that at the bottom end of the S&P 500 are starting to gather some strength. And we can see that the mid-cap index is above its all-time high as well. Now, the mid-cap index is the next 400 after the S&P 500. So the S&P 500 equal weighted, showing some strength, is showing at the bottom end of that S&P 500, which is above the mid-cap, are also showing some strength. So it's creeping down into the smaller cap. So in a raging bull market, we would also have the dollar SML, the small cap, the S&P 600, also above its all-time high, which it's not at the moment. And we will have a look. We'll keep an eye on that and bring it to you when we do. So quickly to go through commodities now. The CRB commodity index isn't quite got above its 50% relative, the Fibonacci retracement here. What is that? Got a long-term. This goes back to 2008, where that peak was. Long-term Fibonacci, and this fulcrum of the 50%, we really want to get above that, and it's showing a lot of resistance at that fulcrum level at the 50% Fibonacci to get above it, and weakness against stocks, relative strength. So equities outperforming commodities. The one that really we need to keep an eye on is gold. So there's gold well above all these attempts to get through. Underperforming equities now, just slightly matching it, if you like. So even though it's had a breakout over the last month or so, it's only matching equities. That strong price action. This is the retracement, which has been pretty shallow. And from a technical analysis perspective, this should see gold continue higher. And that's what we've got to see. It's got to be a new breakout for that to happen. But is this really gold rising because of the fundamentals of gold, or is it sentiment driven? And also, as we discussed a couple of weeks ago that somebody raised, is it connected to the strength in Bitcoin? Now, that last statement is a pretty new one, and we're still finding that out. But there are times when there's a strong enough correlation between gold and Bitcoin that it could be. And we have to wait and see. Not enough evidence for that at this stage. Right, I'll get to the couple of questions. I will get to those at the end. Silver's not reacting like gold. It's still in this downtrend, way above its all-time highs, and still hasn't broken above this resistance level as well, which might add a bit of weight to the fact that gold, because there's no correlation that we've been able to see it between silver and Bitcoin, and typically silver does follow gold. Not immediately, and sometimes it does play catch up and then outperforms it. And there's some 40 or 50 years of data that shows that happens enough times to give it some credence. But silver's not following gold here, so maybe there is something in the fact that gold is reacting to Bitcoin. And not saying that's exactly the reason, but it could be. Copper is broken out of this long-term downtrend and found resistance around about the $400 level, and it tends to keep that. So let's see what happens. Yeah, the breakouts occurred, come down, found some support, and let's see where it goes from there. And the next is oil, and oil is in an uptrend, matching equities and rising, which might play a little bit into inflation, which if it does too big, then there's some fundamentals happening in oil as well. Right, this is a new chart I've introduced. It is it's Bitcoin relative to the GBTC, which is the ETF that kind of follows the cryptos. Mostly it is Bitcoin. But just something to point out here is that GBTC relative, and this is relative to Bitcoin down over here, is sometimes it outperforms and sometimes it underperforms. So just a note over here, because this ETF, which trades on the ARKX in the US, is a way of getting exposure to Bitcoin, and by just trading it on the US market, and rather than going directly into Bitcoin. So here we have just a note here is that when Bitcoin fell, GBTC fell by more. That's showing that Bitcoin, Bitcoin is coming down here. Bitcoin's underperforming, and their Bitcoin outperformed the ETF. So in a falling market, Bitcoin outperformed. In a rising market, Bitcoin seems to be underperformed in this period over here. But just of recent times, they really have matched each other. So it's becoming more and more, not quite a tracker, but becoming closer and closer to how the Bitcoin price does move. So that's still an evolving market, if you like, an evolving ETF. And I'm sure they've got a whole bunch of things that they have to work out of their modus operandi, because I think I haven't looked at it in detail, but I suspect what they'd like to try and do is become an ETF that tracks Bitcoin. Not quite there at the moment. Just on Bitcoin, where is it at the moment? It has it's had a big update. It's got above its all-time high, fell below it, back into the range, and then rose above it again. So it's finding a bit of resistance and support around here, a bit of confusion. Should be in this price action, because that was a strong run from there. It went up 90-odd%, and after such a strong run, it should have take a bit of a breather, like the equity markets are at the moment. And just using a non-mechanical, subjective way of trading, and it seems to work quite well using the stock 26.9, is there was a sell signal on Bitcoin over there. And the same in Ethereum as well, sell signal there, not at its all-time high yet, but approaching it. Quickly to finish commodities, the uranium is having a bit of a price fall at the moment. From its hasn't got to all the giddy heights that it got back there, but it's well within this trading band, if you like, or this channel in the rising, and should find some support around 70. The iron ore price has fallen back to 110 level mark. It's still above this gray upper channel line or trend line that I've got here, and it does need to find support at this level for it to continue rising and lead into the iron ore stocks. And thermal coal is at support levels, does need to hold, otherwise it could be a fall to a much lower price. Okay, that covers it. Let's get into some questions. I'll just go back to here and just get back onto the equities chart. Vernon is saying Saxo Trader has reduced its US trading fees. Thank you, Vernon. I do know that there's been some talk about it, and their website that we're going to reduce. Andre is saying, from experience, I found that investing in this US market is more expensive, as you need to have a lot of capital, or you need to use CFDs to trade stocks. But then your profits are diluted by overnight holding fees. What methods do you guys use to invest in the US markets? Okay, so this is the exchange rate issue that comes to the fore again. So discussed this a number of times. I'll go over it again because there are obviously some new people along. I have US dollars in that I moved to many years ago, and my premise for doing that was twofold. One was to trade the US market, but also to have a hedge against my domicile, my home currency. So, and the idea is that I have some of my wealth not in Australian dollars. And you go, well, which currency should I go into? Well, the US dollar is obviously one, and there are others you could look at as well, depending on your life and where you've come from and how you view that. But Americans view it the other way as well. They Americans who are long-term investors and who take investing seriously put some of their money into another currency as well, just to hedge the US dollar. So that's what I did. I made that decision many years ago, and I've added to that over the years as well. And I don't have any intention of bringing the US dollars back. So I look at a US dollar in the portfolios that are run, the 2 US portfolios that are run, as being in US dollars and leaving them there for many, many years. And at some stage, if I need them, I'll bring them back, or I will use them as US dollars somewhere else. But if you are trading, if you want to trade the US market purely to trade it to get the growth in its unit currency of US dollars, and your home currency is Australian dollars, then the way not to do it is to have an Australian dollar account where you do US dollar trades, because that means that you are going to pay the exchange rate when you buy to go from Australian dollars into US dollars, and you're going to pay an exchange rate conversion from US dollars back to Australian dollars. And with somebody like Saxo, that's around about 0.5%. So you're adding, think of it as brokerage, another 1% of brokerage onto every open and closing of a trade. That's certainly not the way to do it. So that requires you to make a decision on your philosophy, if you like, of hedging your home currency. If your view on that, for whatever reason, is that you want to have everything in your home currency, then potentially trading the US market's not for you. So I know then the emotional thing that stops people from doing that is, at the moment, the exchange rate, the AUD USD is low for Australian dollar, which means you're going to take a hit of some 30-odd% in the unit value of what you have from Australian dollars to US dollars, which means you should take a long-term view. Is the Australian dollar going to get stronger from here? Or there's no dead cert about that. It could get weaker. Just because 50 cents has been a platform over the long term doesn't mean it could go lower. There's lots of currencies that have gone way lower, but it could also go higher. Nobody can predict that. So it's a long-term decision that you should make, and maybe do it the same. I lucked out. Not all of my money went into US dollars at parity. It is at varying rates. So that is what you should do about the US dollar. So when you look at the performance that's on offer from the US market in unit growth, without taking exchange rate variation into it, it's definitely worthwhile doing it. There's no doubt about it. But you have to solve in your head the exchange rate issue, and a little bit of it is emotional, and it's kind of relative. Be saying because where the exchange rate is now, it means it's going to go higher. Well, we don't know that. Right. Any other questions? Okay. Theme for today is that the markets are taking a short-term breather. The short-term breather is in line with just normal market movement. It doesn't mean because there are 3 red bars or three falling days in a row that it's going to fall in a heap. And that is why we trade mechanically and we follow our rules, because we don't want to allow noise and outside influence, internal influence as well, in our own self-sabotaging thoughts that we have. We want to trade price. So I'll leave it there. Thank you very much for your time and attendance, and I wish you consistent, objective, and peaceful investing.